Welcome to Real Estate Exchanges using Section 1031 of the IRS Code. Welcome to the basics. First of all, I want to make sure that you get tax advice, accounting advice on doing any type of real estate transaction. You need to have solid advice because everyone's situation is completely different. My name is Joe Larkin. I'm from Denver, Colorado, and this is just basics of 1031 real estate exchanges. Got over 40 years experience in the business as a broker, counselor, and appraiser. A lot of real-world battle scar experience from the investment side and the occupier side. I do a lot of financial modeling to help investors and occupiers make the right real estate decision as a real estate counselor. Certified general appraiser. I'm Argus certified, meaning that I took the serious test and I know Argus very well. As a matter of fact, a couple times they flew me down to Houston, Texas, headquarters of Argus, where I helped train the trainers on real-world experience and applications for Argus. I'm a proud alum of the University of Denver. I have a master's degree in real estate. Also, I'm in an appointed position as an adjunct professor at the Burns School. I was a lecturer for 10 years at New York University in Midtown Manhattan. Also, I was a CSAM instructor where I was an international instructor, flew around the world and trained folks on investment analysis and occupier analysis. And I did win the Instructor of the Year award on 3 separate occasions. So let's talk about candidates. First of all, anyone could be a candidate. There are some exceptions, such as your primary residence and if you're a dealer. But people need to strategize. And I always recommend to my clients, always acquire property and work from with the end in mind. Think about what it is. How would you dispose of this asset throughout the real estate ownership cycle? Single-tenant buildings, manufacturers, financial institutions, they all could actually benefit from Section 1031 of the IRS Code. Family offices use this. I work a lot with family offices and family trust. Syndicators potentially. Public-private equity may do this. Also, capital markets, REITs, and both private and public. Drivers or financial and non-financial issues should be evaluated. And this should be done at the beginning of the acquisition, at the beginning of the ownership cycle. Brief history. First income tax was imposed in 1918. At that point, you had to recognize a gain or loss and disposition of real estate on property. 1921 provisions were made, and also the Tax Reform Act of 1921 was limited, but it added a few things that are no longer available. Right now, Section 1031, the only beneficiary of the recent tax changes is the real estate. A big court case that kind of changed everything was Stalker versus the U.S., and you may hear that as a conversation in a lot of real estate circles. And Stalker allowed a delay exchange. Tax Reform Act of 1984 codified the Stalker decision and established some rules that I'll talk about momentarily. The rules of 45 and 180-day limitations, meaning that you have to identify the replacement property or replacement properties in 45 days and close on them within 180 days from the transfer. Some basics. So exchange is no longer a swap. Back a long time ago, people had to swap deeds to qualify for an exchange. So now it's pretty much like a sale and purchase with very little difference. The 1031 exchange transaction is very similar to a closing, and we'll get more involved with that momentarily. Documents create the exchange, and so it's very important to get in front of this and also have an attorney on board. A lot of states, they don't use attorneys. They use title companies to close. Get yourself an attorney. Make sure you understand who is doing what and why. Some important facts. First of all, what qualifies for 1031? First of all real estate will qualify. You can exchange a single family property for a multifamily or a hotel. It doesn't have to be identical types of property. But there are some crazy things that you may want to consult with an attorney or a specialist in this arena. But property held for trade or business or property held for investment will qualify for a 1031 exchange. Inventory property, if you're a dealer of real estate, you're flipping properties. Even if you hold it greater than 365 days, you may be considered a dealer, and 1031 is not applicable to you or for your personal residence, cannot be exchanged. What we look at is the intent and your actions over a period of time. For example, if you buy a property and put a sign up for sale right away, but you don't close on it to a certain time frame that you think is enough, what was your intent? Was your intent really to flip it and be a dealer, or was your intent as a long-term investor? Like kind has to be held for productive use or trade or for investment purposes. So you can exchange, let's just say that you own a car wash. You can exchange your car wash. Now, granted, there's a business aspect to it. Let's eliminate that for a moment. And you exchange the real estate of your car wash for a 4-unit apartment. So like kind real estate, intent, very, very critical. Your intent right from the get-go and your actions over time tell the story. Boot's an accounting term and doesn't appear anywhere in the Internal Revenue Code. And so boot is anything that's not real estate that you may receive in the transaction. It could be reduction of debt. It could be relief of debt. It could be equity. So boot is something that is going to be classified as taxable and doesn't qualify for 1031 exchange. So it's non-like-kind property. Realized gain, recognized gain, and realized gain, the net. So the realized gain is the actual gain from the transfer. It needs to be reported on your income tax return as if it's sold for cash. Realized. Recognized in the exchange, typically boot, mortgage relief, or cash is recognized. So during that tax year, you're going to recognize the fact that you received something that was other than exchange, that you exchanged into that was not real estate. That's going to be taxable. That's your realized gain, less boot, cash, and loan relief. It's going to be unrecognized gain at the time of sale. So you have unrecognized gain. That's what you're going to be deferring into the future. Here's an example. Let's say that you're relinquishing a property that's $750,000. You have $400,000 of debt. The cost to close is $50,000. Net equity is $300,000. Pretty straightforward. Again, this is just for demonstrational purposes only. The property that you acquire in replacement is $600,000. The debt on it is $325,000, and the net equity is $275,000. You're going to have boot of $75,000 from debt, reduction of debt. And this is very important for a lot of investors that are going to consider 1031 exchanges. The lower the debt, the better off you may be based on your strategy. So strategy is so critical if you're looking at a 1031 at the end of the ownership cycle. And then obviously we have net equity of $25,000. That is going to be classified as boot, and that will be not deferred, and you'd have to pay tax on that. Key thing, qualified intermediary will create the exchange transaction, and a qualified escrow or trust will hold the proceeds. Now the law basically says anyone could be the intermediary. That's the person that holds the cash during the exchange, except anyone related to the transaction. So I guess in theory, if you have a brother or sister-in-law that you want them to hold your $1 million, that could actually work. However, I strongly recommend going with a company, title company, that is large and has insurance, et cetera, et cetera. I would look really, and it doesn't cost that much. So look at choosing someone, and I can't name anyone because I don't want to, but choosing a title company that will actually has credibility, and more than likely you're not going to lose your money. So you want some guaranteed or security arrangements on the exchange proceeds somewhere. And also interest paid, that could be negotiable, but typically it's still your money till you close. And right now in today's marketplace, you don't really earn a whole lot of interest. One alternative is you can exchange into something less than fee. Fee is complete ownership, the land, the rights, the improvements. In actuality, you could exchange into a lease and acquire a lease. A lot of investors like buying leases. And you're not buying the building, the structure of the land, you're just buying the cash flow. They have to be 30 years total, including renewal. So you can have a 15-year lease term remaining. And if you have 3 5-year options on the lease, that will qualify for an exchange. One thing to point out here is that real estate interest is determined by state law. So things will vary from state to state. As I said before, the stalker, 1979 court case, it's a delayed exchange. And you may hear someone in the marketplace saying that my client or I'm in the middle of a stalker or a delayed exchange, meaning that they have transferred their property over to the buyer, and now they have to identify in 45 and close in a total of 180 on a property. It's a delayed exchange. The exchange has transferred the deed to the seller, and now the intermediary is holding the money to complete the transaction. Time limits, as I said, once the property is transferred, you have a 45-day, the date of sale, to identify. And what you typically do will identify the exchange property that you want to go into to the intermediary or properties. From the date of the sale, you have 180 days to close. There are no exceptions on this. So please make sure your timing is correct. Also, if you go from one tax year to another tax year, you want to discuss this with your tax attorney or CPA or accountant, because you're going to have to file a return and then amend the return in the following year. There are no exceptions. 45 and 180 are calendar days, not business days. Time limit begins and runs out. This is where you want to have a conversation with your attorney in the contract that you're going to disclose. You're going to do a 1031 exchange. And more importantly, some things that I like to include, and again, I'm not practicing law here, but time is of the essence, meaning that you have to close. And if you don't close, guess what? You're going to have to pay the capital gains tax. There's no exclusion, no exemption, no delays in this, so you need to make sure you have this lined up right from the beginning. Exchange time limits. Well, you got the 3-property rule, and that is an exchanger may identify up to 3 properties regardless of value and close on any of one or all 3. There's a 200% rule. The exchanger can identify unlimited number of properties, providing that the total value of the properties do not exceed 200% of the value of the relinquished property. 95% exception to the 200% rule is that you can identify more than 200%. However, you must acquire 95% of all the properties, of the value of all the properties that are identified. So you just can't say, I'm going to identify all office buildings in the Denver metro area. You have to be specific, and you have to communicate that exactly to the intermediary. The identification of the property may include the address, but more importantly, you may want to include more information such as tax identification numbers. Must be in writing, unambiguously describe the property, signed and dated by the taxpayer, and must be received by midnight the 45th day or postmarked. There's limited exceptions, but not too many. I would probably get it in day 40 typically that's what I would do. Here's how it works. Delayed exchange. You are the exchanger. You have a property. You're a broker, or you find someone that wants to buy it. You have a buyer for the property, and so you transfer the deed. You have a sale or closing. You transfer the deed to the buyer. You cannot receive what's called constructed receipt of the money. So what happens is that the buyer hands the money over to your intermediary. Qualified intermediary, we mentioned that, but you need to do some research on it for yourself. And now the clock starts ticking, and the time identification period, you have 45 days to identify and notify the intermediary of your properties that you have identified that you want to close on. At this point, you got 135 days left, or a total of 180 days. You have to close on them, and if you don't, you lose. And what happens is that you find a property or properties, and you contact the intermediary. The intermediary brings the money to a closing. You sign a contract, and what happens is that the intermediary gives the money to the seller of those properties. You take title of that property from the seller, and then it's deeded to you. So this is a real basic delay exchange structure and how it works. There are many derivatives of this. However, for our purposes, it's just very basic, and this is how it works. Again, you need to have some sound advice, lawyers, tax accountants, CPAs, and always start with the beginning and always start with the end in mind at the beginning. And what I mean by that is, what is your plan? What is your overall real estate strategy throughout the real estate cycle? I want to thank you for watching this video, the basics of 1031 real estate exchanges. Always start with the end in mind when you acquire real estate. What is your strategy, your goals over the ownership cycle? Also assemble the right team. You have to have the right team that understands the 1031 exchange and understands real estate investments. Again, thank you. Please give me a thumbs up on YouTube. I also do have a number of other videos that may be of interest to you. Again, thank you.